I mean, look, all of us in the industry are basically looking at 2100 to 2300,
Okay.
in a recession. And I really don't want to, I don't want to look like an apologist, but I want to be sincere. I can only tell you what I think. I think it's a fair question, and I'm very bullish on gold. But again, you don't get rich on gold. If gold
Right.
goes to 2,800 or goes to 5,000, it's like Rick Rule says. I'm not sure he entirely means it. He's afraid gold goes to 5,000 because that means a loaf of bread's going to be $50 to $500. In other words,
Right.
when gold goes up, that means everything else is in shambles. So he's afraid to see it go up. But the truth is, he's investing in gold because it will go up. But it only goes up in dollar terms. That's really kind of a pathetic way to measure a real money or real
But
asset.
Matthew Piepenberg, a partner at Matterhorn Asset Management, has projected a price range of $2,100 to $2,300 for the precious metal. Recent market movements saw gold surging to nearly $2,060 following a soft core PCE inflation report for November. Strengthening this outlook, strategists at ANZ Bank have revised their 12-month price forecast to $2,200 from $2,150. According to Piepenberg, gold plays a crucial role as a wealth preservation asset, safeguarding against the inherent erosion of purchasing power in currencies. Notably, the eastward shift in gold, exchanges, and interest is gaining prominence, driven by diminishing faith in the US dollar and the US Treasury. Examining global foreign exchange reserves, data from the IMF's currency composition of official foreign exchange reserves reveals a slight decline in the greenback's share. The US dollar accounted for 59.2% in the third quarter, down from a revised 59.4% in the previous quarter. Meanwhile, the World Gold Council reports that half of surveyed central banks anticipate the percentage of reserves in USD to be between 40 to 50% in the next 5 years, with just over a quarter expecting it to remain unchanged. Piepenberg underlines a significant trend. Central banks have been net sellers of U.S. Treasuries since 2014, while concurrently making unprecedented purchases of physical gold. This shift signifies a loss of faith in a declining asset linked to bad credit, highlighting gold's growing importance as a reliable alternative. The data from the first 9 months of 2023 supports the notion that last year's record of central bank gold purchases will likely be surpassed. Central banks, in a bid to strengthen their foreign currency reserves, net purchased a staggering 800 tons of gold, exceeding the same period in the previous record year of 2022. Piepenberg suggests that central banks are positioning themselves for a substantial shift, recognizing that sustaining U.S. and bond markets may necessitate synthetic liquidity in the future. Let's delve into key moments from Matthew Piepenberg's interview with these video clips.
Gold, there's a lot to say about gold. For the simple answer to your question is, if there's a ripping bull market based on a word-driven Fed, where, again, words replacing math, resilient, we're supportive, dovish, rate cuts, whatever the Fed wants to say, if you want to believe a lie long enough, you'll believe it, and markets will trade on that. If the S&P is ripping, there's an opportunity cost for speculators. Speculators will invest in equities rather than physical precious metals. Our clients, every single one of them, never call and ask about the gold price, even when it was reaching all-time highs. They don't care because they don't use gold as a speculation tool. So it's a different question how you answer. It's not an apology for gold. Gold is a wealth preservation asset ensuring against dying inherent purchasing power of the currency, regardless of the relative strength of DXY. Gold is just real money, fiat paper money, even the DXY's leading number, the US dollar, even when it's relatively stronger, the best patient in the ICU is still losing inherent purchasing power. So for our gold investors who are looking at wealth preservation, gold is bought for that reason. They're not worried about opportunity costs or getting a better yield or a better return in the risk asset markets. But yes, if stocks are ripping, speculators will dump ETF gold and go into higher performing stocks and follow the FANGs or follow the Big Seven, et cetera. And that's fine. That's fine if you're a speculator. For wealth preservation asset, it's indifferent. But gold's a very long conversation. What's happening this year and what happened in 2023 is fascinating. I think the most important thing that I was looking at, and there are probably 6 or 7 points, but when gold went above 2,100 and then came back down to the 2000s, what was fascinating is on the Shanghai Gold Exchange, the premiums actually went up 3%. Because that's an indicator that this game in London and New York of putting a permanent boot to the neck of the gold price, the spot gold price through OTC futures contracts is slowly coming to an end because You because there's a movement east in gold, and there's a movement east in exchanges, there's a movement east in interest because of the lack of faith in the U.S. dollar and the U.S. Treasury. West can't cap gold while China lets it rip. You're not going to see a 200-day moving average in the U.S. dollar price of gold. It's going to be significantly lower than the 200-day moving average in the Chinese or the yuan price of gold. So there's fundamentals are slowly returning to the gold market. That's very important. Central banks are on pace this year to buy another 1,000 tons of gold this year after a record year last year. I've said in many conversations, this is important when you're watching central banks net sellers of U.S. Treasury since 2014 and record-breaking buyers of physical gold. To me, it's common sense. Again, keep it simple. Watch the big picture. If you were to sit and watch, as I've said before, cannons and horses and tents and soldiers and bayonets marching towards a border at a massive level, that would be common sense that something's about to change, either defense or offense. If you see central banks dumping Uncle Sam's IOUs at record levels and stacking physical gold at record levels, that's suggesting the troops are coming to border because they're expecting change. They're losing faith in a declining asset from a bad credit. They're losing faith in the U.S. dollar. They're losing faith in the U.S. Treasury because our debt levels are so grotesquely high, because they know that the only way to sustain the U.S. markets and the bond markets is through synthetic liquidity down the road. We always go from a pause to a rate cut to QE at some point, like we did 2018. Powell tried the same template, cutting rates, raising rates while cutting the balance sheet. By New Year's Eve in 2019, markets were seeing 1,000 basis point gyrations.
China has significantly escalated its utilization of the yuan to procure Russian commodities over the past year. Multiple trading executives with first-hand knowledge have informed Reuters that nearly all transactions involving the purchase of oil, coal, and certain metals from Russia are now settled in Chinese yuan rather than U.S. dollars. This strategic move by China introduces a fascinating arbitrage opportunity, wherein one could sell oil in London, use the proceeds to acquire gold, convert that gold into yuan within a Chinese trade hub, and reinvest in oil using a currency other than the U.S. dollar. Matthew Piepenburg, partner at Matterhorn Asset Management, underscores the growing significance of gold in this evolving global economic landscape. As geopolitical and economic dynamics transform, gold emerges as a pivotal asset. Piepenburg points to the rising importance of gold, especially against the backdrop of these shifts. China, renowned as the world's leading purchaser of physical gold, has played a pivotal role in driving a rally in global spot gold prices throughout the year. This surge culminated in all-time highs on a recent Monday, with analysts attributing China's increasing involvement as a critical factor behind this upward trajectory. Piepenburg notes a noteworthy trend among young Chinese investors reportedly favoring gold over tech stocks. Let's get back to the interview.
A whole new oil and gold trade in Chinese yuan. You can see China buying oil from Russia, paying for that in yuan, which then Russia can then convert to gold, and they're stacking gold. You're seeing massive arbitrage trades right now. You could sell oil in London, use it to buy gold, take that gold to a Chinese trade hub, convert that gold into yuan, and then buy oil in a currency outside of the U.S. dollar. You have Saudi Arabia right now, which is doing more trade with China than it does with the U.S. and the European Union combined. There are massive implications of that. Again, not making headlines today, not affecting the S&P today. These are the slow undercurrents. But if Saudi Arabia, which is already a talking partner with the Shanghai Cooperation Organization, is already a part of this BRICS new bank, the development bank, they're getting their house in order. This isn't Libya and Iraq. And we knew what happened when Libya and Iraq tried to sell oil outside of the U.S. dollar, whether it was in gold or euros. Gaddafi and Saddam Hussein are proof of how dangerous that can be. Saudi Arabia is not as afraid. Again, I'm not saying the petrodollar ends tomorrow, but these are seismic shifts. And I think, young Chinese right now are buying gold more than tech stocks. They're 5 plays ahead of U.S. investors. They're thinking chess, not checkers. Right now, Pavlovian, we're following the Fed, we're following the trend, we're buying in the stocks, the markets are ripping, divorced from all reality. You're also seeing that the highest Sharpe ratio macro on the planet right now is gold. It's much less volatility, much longer return. We're going into commodity cycles like super cycle. I do believe this, but I think what's even more interesting about gold, because you asked about gold, we look at gold. Gold is a measure of the distortion and dishonesty in the financial markets right now. It's a measure of this disconnect. Typically, gold only loves negative rates, a weak dollar, and low yields. And yet it reached all-time highs on positive rates at 2%, a strong dollar, and high yields. When, what's this pet rock? When you can get no yield on a pet rock, you get 5% in the 10-year. A few months ago, why would you buy gold? And yet gold is reaching new highs. I think that's happening because no one really, the sophisticated money who's looking at preservation, not speculation, really trusts the U.S. Treasury, the U.S. dollar like they used to. It's not the same because there are internal problems and external problems in the U.S. dollar. Trust is very, very hard to quantify. And I'm an American. I'm a patriot. Like you, I've lived most of my life outside of the country I was born in. But I grew up on baseball and apple pie, the American dream, the American education, the hard work ethic. I'm very proud of America. I don't recognize it from what it was 20 years ago or even 10 years ago. And I think these are the things that Europeans, Middle Easterners, Asians, even Latin Americans are starting to figure out. First of all, internally, America is divided into so many things. But what we've got is we've got this failure, this intellectual, this series of failed wars that we were, like Condoleezza Rice said, that Russia ran out of money before the West ran out of energy. So the West followed us into these ridiculous myopic sanctions against Russia, which completely backfired. Poland's going nuclear. Germany's in a recession and they're burning coal. So that was a lie. That didn't work. That plan didn't work. That failed war in Ukraine didn't work. That failed war in Afghanistan didn't work. A series of failed wars. We have a weaponized Department of Justice. We have a fourth estate that is so far from Woodward and Bernstein. We've got open censorship in Google, YouTube, and frankly, anything. So I'm saying we don't trust. Internally, we don't trust. And externally, I've got news for Americans in the U.S. The rest of the world, including people who love America, don't respect America the same way in general because of political and social and financial policies and military policies. But they most importantly don't trust Uncle Sam's IOU because it's from a bad credit that's over its skis and debt at record levels. And they don't trust the U.S. dollar in the same way. We're seeing a clear sign of commodity markets de-dollarizing, which we can get into. There's a big debate about the degree and speed of that. I agree it's not going to happen overnight. But there have been seismic shifts, as Grant Williams and I warned, ever since that myopic policy, that when we weaponize the dollar, we shot ourselves in the foot.
How might China's increasing use of the yuan in commodity transactions impact the global economic order, especially considering its strategic implications for trade dynamics and currency preferences? What broader implications could the observed shifts in China's currency usage and the increasing importance of gold have on traditional financial markets? And how might investors and policymakers respond to these changing dynamics? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel. And remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.